It's happening, maybe. Japan might have just started the global Treasury liquidation. We've been talking a little bit on this channel recently about how the United States Treasury is the foundation of the entire global financial system. But what happens when you build your house on a foundation of sand? Eventually, the house comes crumbling down. And the way that starts in the financial system is by the world getting rid of treasuries. Japan has historically been one of the largest treasury holders. They have not been buying them recently, and now, because of the problems in their currency, they've intervened to stop the collapse of their currency, and they may have just started the beginning of the end of the current global financial system. Ready? Let's dive in. All right, so just a few days ago, before the time of this recording, Japan was facing some liquidity stress with their bonds because of their yen collapsing here. So if we look at the bid-ask spreads for their own government bond, we see that there's some liquidity stress there in their bond market. Basically, what Japan has been trying to do is yield curve control. They don't want the yield on their 10-year government bond to go above 25 basis points. They're trying to peg it basically at 0. Now, that's a problem because you have to print currency in order to buy those bonds to keep the interest rate low. And so if we take a look at the yen as measured in US dollars, we can see here that it has just been collapsing recently. It has been falling because they have to print so many more yen to buy their government's debt to keep that yield low that it's just ruining the value of the yen. This has also contributed to the dollar getting much stronger over the same time period because the dollar, the DXY, is measured against a basket of currencies that includes the yen. And so the problems over across the sea in Japan have been contributing to a stronger dollar and vice versa. But if you notice here, as we zoom in on the yen, just within the last 24 hours, there is a big spike in the value, in the price of the yen as measured in US dollars. So what happened here? Well, Japan intervened. The Bank of Japan intervened to stop the yen from sliding. This happened around 4:30 a.m. on Thursday morning Eastern Standard Time. It pushed the dollar down more than 2%. So if we break this down to a minute chart where every candlestick is a minute, you can see here, this is when the Bank of Japan started to intervene here. Again, right around here, and the value started to spike and it's leveled off since then. If we take a look at this same chart on the dollar, we can see that the value of the dollar started a decline and then has leveled off a little bit since then. Now, here's the thing about currency interventions. Other countries do not like it. Other countries do not like it when one country just goes off on their own and intervenes to try and change the value of their own currency arbitrarily and quickly and swiftly because it has a direct impact on the value of all the other currencies. And so when we look at what the Treasury said, we can see that a spokesman for the Treasury came out and said, hey, the Bank of Japan intervened in the Forex market. We understand their actions, which aims to reduce the recent volatility, which that's not volatility, it's just the recent decline in the value of the yen, and also added that the US did not participate in the intervention. Now, we know a couple of months ago, Yellen actually went to Japan, and there was some speculation, especially I was talking with my good friend, Nobody Special Finance, his YouTube channel I was on a couple of months ago, and we were discussing this. Why was Yellen going to Japan? Well, it could be to tell them, hey, we don't want you to start dumping treasuries, even though you have a problem here. We don't want you to start dumping treasuries and participating in hurting other currencies. Yellen said that in general, our view is that countries like Japan, the United States, the G7 countries should have market-determined exchange rates. Only in rare and exceptional circumstances is intervention warranted, and we did not discuss intervention. Now, here's what's weird about this. We have to look at how Japan intervened to stabilize the yen and stop it from falling. Because when you look at the yen versus other currencies, what are you exchanging for yen in order to stop it from falling? Because you have to start to buy yen back from the market to push its price. So what are you giving to the market to use to buy those yen? Now, the answer here is probably multiple currencies. However, it's possible they don't have a huge amount of foreign exchange reserves to do that with. In fact, we can see here from this chart over the last year or so, their foreign exchange reserves have been dropping significantly. However, one thing Japan does own a lot of is US Treasuries. In fact, you can see here on this chart, they are the largest holder of US Treasuries. Now, in the past, they've always been buyers, especially during hard times. That has not been the case over the last year or so because they've been dealing with their own problems. So is there any evidence that they started dumping some US Treasuries in order to get dollars in order to use to buy back yen? Well, if we look at the yields on the 2-year Treasury, and we are now looking at a 1-hour chart, and we are looking at a 5-minute chart here, we can see that there was a little bit of a spike in yields on the 2-year. However, there was a massive spike on the 10-year, an even larger spike on the 20 and on the 30. We can see right around the same time here that the Bank of Japan stated that they started to intervene. We saw massive spikes in the 30, in the 20, and in the 10-year yields. But interestingly, not the 2-year. This is more evidence that Japan started selling these US Treasuries because they wouldn't have many 2-years. They're going to have mostly the longer end because they're storing these for reserves. This isn't like American corporations using T-bills and short-term treasuries as basically cash instruments. And here's the potentially scary part. What Japan is doing here to try and rescue their own economy. They're trying to peg yield curve control, keep rates really low to spur on economic growth. But since that was harming their own currency, they start to intervene in the currency markets to try and save the value of their own currency. But because they don't have enough foreign exchange reserves of other currencies to do that, they have to sell something to get other foreign currencies so that they can use those to buy their own currency back. And they happen to have a large pile of treasuries, as do most central banks around the world. And the key here is that most countries around the world that have a lot of treasuries are also about to have major economic problems. And so if Japan can get away with or can be forced to start to sell treasuries in order to get dollars, in order to buy its own currency, in order to try and save its own currency value and be stimulating its economy with low rates at the same time, other countries may follow suit. Take a look with me here at this statement from Luke Grauman. He said, way before Russia collapses due to the loss of the EU as a customer, energy prices needed to balance supply and demand for energy will push the EU, UK, and Japan, key there, Japan, into current account deficits. It will likely push them into Southeast Asia-like currency crises. This would look like the euro, the pound, the yen collapsing versus the US dollar. In turn, this will drive the US dollar higher in a super spike, breaking global markets remarkably fast. And here's the key, even the US Treasury market. Why would a higher dollar cause a collapse in the US Treasury market? Because everybody will be selling US Treasuries in a desperate clamor for US dollars. When that happens, there are only two choices or only two outcomes once everybody really starts dumping Treasuries at the rate that Japan just probably did last night. Either the system will completely collapse or the Fed will be forced to renew QE and have to buy up all those bonds that everybody else is selling. And the timing indicated here is right on point. The crescendo of this scariest macro environment for the past 5 months is looking to arrive in September and into the fourth quarter of 2022. And right on cue, in September here, the Bank of Japan has most likely started selling some of its massive stockpile of US Treasuries so that it can get dollars, which have gone up in value, hurting the yen, and use those to buy back their yen, defend their currency so they can keep their own rates low, and other countries will most likely have to follow suit, especially as we head into colder months, into winter, and energy starts to get shut off. Russia starts to pinch Europe even tighter, and they're forced to start liquidating the only assets they have to be able to keep on affording the things that they desperately need to survive. Which means that in the past, every time time the US dollar has spiked, we've seen emerging markets crises. And what this is doing is showing to the entire world that most of developed countries have gotten themselves into financial positions that are equal to or worse than what most developing or emerging markets have had in the past. And then when a crisis hits, we realize they were all bankrupt from the start. You cannot be irresponsible with your financial choices and expect to avoid the consequences forever. And if right about now you're wondering how in the world you can make sure that you are not vulnerable to crazy black swan events like this, I've got the solution for you. Portfolio Allocation Mastery course, discount linked for you in the description below. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.